Every dividend tells a story. Today we're looking at the story SCHD has been telling me for the last 9 years. Thousands of investors buy SCHD, expecting it to make them wealthy, but very few stick around long enough to find out what actually happens. I've owned SCHD for nearly 9 years through bull markets, bear markets, dividend increases, a stock split, even selling part of my position. Today I'm going to show you exactly what happened, what surprised me the most, and whether I'd still buy SCHD if I were starting over today. So stay tuned. Welcome back to Simply Money. If you've watched this channel for a while, you know SCHD has been one of the foundations of my portfolio. It's not the highest yielding ETF I own, and these days it's no longer my biggest income producer. But that's actually what makes this conversation so important. One of the biggest mistakes investors make is judging an investment after 6 months or even a year. Great investments reveal themselves over time. 9 years gives us enough history to separate hype from reality. In this video, I'm going to walk you through what SCHD actually did for my portfolio. We'll look at how my income changed over the years, how the stock split affected my holdings, why I eventually sold part of my position, and what I would do differently if I were building this portfolio today, and whether SCHD still deserves a place in a retirement income strategy. This isn't a hypothetical backtest or someone else's portfolio. These are the lessons from nearly a decade of owning SCHD with real money. So what I want to do is, first of all, welcome you to Simply Money. If you're new here, I appreciate you joining me. For our returning viewers, thank you for all the support, all the interaction, all the great feedback you guys give me. I love having the conversations in the comments, so please go ahead and ask the questions, make the comments, and let's continue to dialogue and help one another find our financial freedom. So what we're going to look at here is my dividend growth sheet. This is what I'd been using to track my individual funds and then how much they paid and the dividend they paid and how much those have developed over the time, where I track things. I do have a new one that I've built. I haven't got it fully loaded for my portfolio. And for this particular video, I wanted to show you the history of it and be able to give you all the information exactly how it was. But the Portfolio Manager is a new platform we have to help you actually manage your account. And this is the dashboard. And you can see things like you enter in your starting balances of everything. And I'm not going to go over all this now, but I am going to give you a quick overview. You put in your transactions. Once you set it up, this is all you do is put in transactions. If I get a dividend, if I make a buy, a sell, a deposit, or withdrawal, I put that in this transaction sheet. It updates my portfolio automatically, provides me income reports, gives me health checks to make sure I haven't forgotten anything, and that is the Simply Money Portfolio Manager. And the more you add to this, when you start out, it's not going to have things like income growth because you haven't had any income yet. As you can see on my income report, my monthly income's only showing SCHD because that's the only one I went back in and put all of the transactions. I'm going to build this for going from here forward. So when you see this, the other funds are going to be, I got them pretty close with the cost average and everything. They might be off very slightly, but nothing that's going to change the outcomes. And for me, this is a new tracking I'm going to be using from this time forward. But I want to go back to the old way I'd been tracking, the dividend growth sheet. If you like either of these or any of the sheets, are all available in the link below at Buy Me a Coffee. You're welcome to get one there. Appreciate all the support. Now let's look at SCHD. Back in 2017, we put in about $200,000. Cost at the time was $15.10. Now that brings us to point number one. Later on down the road from here, they did a split 1-3. For every one share I had, I got 3, but the price dropped by a third. The dividend dropped by a third. It's just more of a bookkeeping thing. When people see, especially ETFs doing splits, that is to make either the price more affordable when it does a positive split, like for every share you have, you get 3. But if it does a reverse split, for every 3 shares you have, now you only have 1. It's just a bookkeeping thing because for the amount you own is still the same and the dividend you get per share is still the same. Doesn't mean down the road it's going to continue to perform like it has, but it's not as fearful of a thing as people make it out to be. There's other reasons why, but if you see a split or a reverse split, do some diligence on this. Go in and research a little bit. Why are they splitting? How has it been performing? How has it been holding up and cash flow and different things? There's a lot you need to look at. But just because something does a split doesn't make it bad or necessarily good. A lot of people say, oh, it's splitting, I'm going to buy some right before it splits. Then I'll have 3 times as many. You still have the same value. Sometimes it'll have a hype momentum coming into it because people think, oh, look, it's cheaper now, I'm going to buy it. They're not doing their due diligence, so they think, oh, it was $60, now it's $20, I'm going to buy a bunch. And that's where you'll get a bump in these sometimes. And then you have other people like, oh, I'm going to wait till after the split. So you just have to do your homework on that. Don't just read into splits as a good or bad thing. So again, we had $15.10 per share. We were able to buy, at that time, 13,245 shares, which equals at $200,000. And this is the thing. A lot of people don't like SCHD for 2 reasons. The entry yield at the time, I think it was about 3.25%. Somewhere right in there. It's pretty much what it averages. They don't like that low yield starting out. The other thing they don't like is its quarterly payer. Now, let me just clarify. For me, I was building this as a portion of my portfolio 10 years ago to continue to build value and to generate ongoing income that grows. Because as you'll see, the dividend per share amount continues to grow year after year. And that is important to me. And I wanted that as part of my foundational bedrock of my portfolio. The reason, and we'll get into this in a minute, I sold some, I'll share that with you, because some people are like, well, if you built it for a foundation, why did you sell out of some of it? And we'll get into that in a minute when we get down to where I did sell it. But the other thing is I was building a growth portfolio and an income portfolio, but I wanted the income portfolio still to have growth of the underlying price. I wanted the share value to go up, not just the dividend. Those are 2 factors why I chose this. Back then, I was building these 2 streams, 2 portfolios, one for income, one for growth. And we'll get into that more again in a minute. So let's look at what happened. Immediately, right after I bought it, I got the first distribution, which was only 10 cents per share. And a lot of people will be like, oh, that's horrible. It paid me about $1,438 my first quarter. Now, it felt really great because I'd only owned it for about 2 or 3 weeks there. And the stock price had actually gone down a little bit, but I was just reinvesting, so it did not matter to me. And because the share price was down a little bit, I was able to get 97 more shares, and we'll continue to see how that worked out. So my cumulative shares grew, and my total value was down slightly because the share price dropped 31 cents. So let's look at one thing first, and then we'll kind of bounce around a little bit. The dividend per share, as you can see, started at 10 and 11 cents per share for the first year or so, and it went down here. This one would scare a lot of people. Oh my gosh, see, this is a horrible fund, down to 8 cents. But look at that. The dividend, the distribution still wasn't that far down because I was reinvesting and buying more shares. But the share price had come up quite a bit too at $16. Things happen. I didn't panic. I was in this for long term. This was one of my kind of set it and forget it. And I really don't want to say I forgot it totally. I kept an eye on things and all, but I set it until I got to a point where I was starting to shift and prepare for retirement, because I don't want to do a lump sum conversion. Some people do. They're like, I'll do all growth, and then at the time I'm ready to retire, I'll sell all that or sell some of it and get into some income. Remember, I always say personal finances are personal. I made my personal choices. This is not financial advice. This is for informational and educational purposes only. When you buy and invest, you have to remember that comes with risk, and that risk includes loss of capital. You have to do what you feel best with because it's your money. It's real easy to tell other people how to spend their money, how to invest their money. It's a whole different story when you're the one and it's your hard-earned cash. Some people have no fear. Some people, to me, in my opinion, go to an extreme where they're almost gambling on this stuff. For me, I have a pretty good risk tolerance, but not extreme. I'm pretty balanced. I like having some long-term hold, set them and forget them. I like nice foundational like SCHD. And I like some other stuff that's a little bit more aggressive, but not out of this world aggressive. And then the ones that are a little more aggressive, I monitor them much more. Like SCHD, I don't monitor it that closely. I watch it, I read some stuff on it. But at the beginning, maybe I watched it a little bit more just to make sure. But before I got into it, I had done a lot of research on this. And now I don't. I like their underlying processes. I like how they do the reconstitution and rebalancing. Those things just make me feel good. And it's part of my hedge against volatility. That's why I do it. Now, as you can see, the share price the next year was going up to 13 cents. It bounced down a little bit. You got up to 13 cents there, 13 cents in 2018, and then it went down a little bit. And again, people kind of get fearful. Remember two things. One, it's not about is one quarter over another quarter better or worse. Sometimes quarter to quarter is going to go down. From December down to March the next year, it went down. But then look at July. It went up. Remember, it's not just about week to week or month to month or quarter to quarter. It's about year over year and long term. That's the wonderful thing about SCHD. Year over year is continuing to grow. We can see that here, the annual growth. The first year was up almost 7%, then 20%, almost 18%, 11%, 14%, almost 4% there, and 12%. So you can see year over year, it is growing. Sometimes not as fast, other times much faster, but the average is like 10, 11% year over year dividend growth, which is one of the reasons I got into it, because I not only wanted the appreciation of the share price, I wanted the appreciation of the dividend. As we come down, you can see my dividend payments growing from $1,400. Then we get down here, we're up at $2,600, $2,900. Quarter to quarter, it dropped a little bit more, but back up to $2,900. Then we're at $3,100. Then down a little bit, and then we're up to $3,600. See the pattern? It's just like the stock market. It goes down, goes up, goes down, goes up. But over time, the last high in the dip, you get to new highs. And that's part of the process. And if you can't handle that, you might not want to be in investing, because that's how any fund you have that has any risk at all. Unless you want to put it in a CD or high yield savings, there are risks involved. And this is a pretty low risk situation here. A lot of ETFs out there are, but there are some that are much higher risk. So you have to know what you're looking at. I want to bring you down here where now we're up at $4,600, $42, $45. Then our highest payment there at $4,600, we get another one of $4,500. This is where my payments started dropping. As you can see now, you're looking at $3,200, $3,000. And $3,000, but that's because I'd started my shift toward retirement. Whether that happens next year or 5 years, I don't know yet. It's a play it by ear. Just wait and see what happens. What we feel in our family and what we feel is right for us and meeting some of the goals we have. Now, some people saying, why don't you do it now? There's different reasons. And again, that's personal, and you need to make your own decisions when it's right for you. As you can see, that payment drops, but you can see how many shares were sold over this course of this time. And some people, again, backseat drivers, 20/20 vision, they say, oh, look, this is where you sold at. And look where it's at as of right now is the filming of this. And like, oh, you should have waited. Well, I could wait 20 more years and it's going to be up more than it is now. So at some point, I had to make the decision I'm going to start doing a little shifting. I didn't cut it all. As you can see, we still have almost 12,000 shares of this. It's a still very healthy position. I'll show you again on the portfolio manager. As you can see here, the allocation is still 55% of the income portion of our portfolio. It's still a very strong foundational position. Part of the reason for this shift here is because it was getting way too heavy, and I wanted to shift into the income growth part now toward retirement, because one of my goals, is to have my portfolio where my income generated totally takes care of all of our bills, all of our travel, all of our life. But I also want it to have extra income, because I want to have a buffer, and we'll do a whole video on why that is. But for example, if my highest paying dividend gets cut in half, I want to make sure I have enough buffer to continue to cover my cost. Yes, I'll have a cash basket for emergencies and for really bad markets if we go into a bear market and all the dividends get cut. That's a good thing. And you'll see how something like SCHD not only prevents that, it helps alleviate over the long term because it's growing year after year too. It's not staying the same. if I started taking these distributions, they would still grow. Not as fast because I'm not adding as many shares. There are reasons for everybody to do things differently, but that's why we sold out of it. As you can see, our final distribution is of June 29th this year, $3,000 in this 10 years. And this isn't amazing. I could go put this amount of money into lots of funds and make way more income. If you've watched my Ulti recap from 1 year, I was generating tons of income, but the flat or declining share price alleviated it. It was basically a net loss, zero. There was no gain, no loss. It was just done. And so I could put it in something like that and tons and tons of income, but I don't feel like that's where I want my foundation. If that's a satellite position, okay, go ahead and do that. But you have to make your decision. Over this time frame, almost 9 years, $107,000 of income has been paid to me that I've reinvested. And if, say, today I decided I'm done, I'm going to start living on my portfolio, I'm getting about $1,000 a month off of this position. Will I continue to keep it at 50% of my portfolio? I don't know. That will be part of the decision I make along the way. But that is the power of this. You can see our ending share price. Remember, we started at $15 and now we're at $32.35. So it has more than doubled its share price. In 9 years, I'm happy with an income growth fund that doubled its share price. That's a balancing hedge against volatility and dips that still doubled its share price in 9 years, allowing the portfolio to gain $187,000. But that's after these sales. The current value sitting right here at 387, we would be able to add that amount if we hadn't sold all this. But then my portfolio on the income side would be way off kilter of where I want to end up at. What I'm doing now is I still buy a little bit of a SCHD with drips or from other income producers as that comes in. SCHD takes another little pullback, I might buy into that. Pretty much everything I have set now is, I call it dripping, but it's really not. I'm not just automatically reinvesting it. It goes into cash, and then I watch and see if the market's in a big boom or wait for a little pullback. If it's just been kind of consistent, I just put it in. Now with SCHD, because those payments of $3,000 come in all at once, I sit that in cash and I gauge it on the market at the moment. How's it been doing the last month or the last week even, and kind of watch, do I want to buy some now? Do I want to deploy that somewhere else? If the market's just had a huge week, I might hold it for a few days or even for a few weeks as I watch the market for the next little pullback. So that's just my kind of process and how I do it. Now, people would ask me, would you do it again if you were to start today? Well, that's kind of a double-edged sword, because fundamentally, yes, I will and do keep buying SCHD. Would I lump sum like I did back then, that amount? Probably not, because I'm 10 years older than I was back then. And I'm 10 years closer to when I'm saying, okay, I want to start using the income. So I might do maybe half of it and deploy the other half somewhere else. But overall, yes, absolutely, I would buy SCHD again. A lot of that depends on your goals and your age. So take that in consideration as you look at that. But that has been the process of my SCHD holding. I know I've shown this on my monthly income recap, but I have never really gone into depth on why I held it. The other thing I want to show you, and I like showing this, especially for new people who haven't seen it. If you've seen this before, thank you for bearing with me. I have one more thing I want to share with you. But before I do that, I want to share with new folks some things to watch out in this fund or any fund. I want you to see right here, as the fund was growing, we got up to our high right around here, the end of 2019, even early into 2020. So you can see it had grown just in those 2 years, about $77,000. A lot of people, if you were holding this or another fund, you might look and be like, yes, this is great. I love this. Then look, all of a sudden, remember March 2020, COVID? It drops down $55,000. You're almost back to where you started. And I remember COVID. People were panicking. People were getting out of everything. You know, the world was coming to an end. And I'm not minimizing the fear. It was a horrible situation around the world. But what I'm emphasizing is your mentality with investing, how news and life can really impact you in making decisions. And a lot of times, very emotional decisions. Investing is half, if not more, emotional. It's far less analytical than it is emotional. So the first thing I would recommend you do is really get your emotions intact, because if you had panicked and were like, I got to get out of this, you would have missed the recovery. And look at that. By September, you're basically back to where you were in March. And then by the next March, you would have been up $100,000 from where you were at your high before. This is where panic comes in. People were panicking, and I knew some of the fundamentals were not going to change in a short period. Now, if that had lasted for 2 years, 3 years at the same level, yeah, it could have really caused some damage. But I looked at some opportunities of some big sales of ETFs and stuff that I felt really strong about. In this process, you're going to have some ups and downs. Again, look here. If you had panicked in this March of 2020 and right before I sold, let's look where it would have been. 5 years later, look at that $225,000 increase. So that is really important to remember. And it's not just SCHD, it's any fund that you can really just step back. Did the underlying processes change? Are the underlying companies the problem? That's why I like ETFs. SCHD has 100 companies, so I'm not worried necessarily about the companies pulling it down and destroying it. Where if maybe I owned, and I always use these examples because I'm old, maybe if I owned all Sears or I owned all Kodak, my funds would be gone because those companies went down. Where SCHD and other ETFs, you own a basket of companies. So even if a handful of them get bit in the butt or a whole sector gets destroyed, you have a basket of different companies, a mix of different sectors, and they keep it balanced. They don't allow any single company to get more than 4% allocation, and no sector to get more than, I believe it's 20% allocation. So it keeps things really balanced, and I love that. The final thing, and this is why I want my viewers to stay that have been here before, this is a big part of my personal retirement plan because I want it to be foundational. I don't sweat it. It helps me sleep at night. I know even if my higher incomes take a hit and it goes through an extended period, the SCHD, unless they change their fundamentals, is going to continue to build my income. It's going to continue to grow. Not only will my principal grow, that I'm not selling shares, but my dividend will grow as well. And that's very important to me. So it's part of my retirement strategy. Again, thank you for joining me. Don't forget to hit that like and subscribe button. It really helps us out. And if you like this dividend growth sheet or the new portfolio manager, which is really dynamic, we got lots of stuff coming to add to that as well. Please go ahead and grab one of those. That helps the channel as well. And I appreciate all your support. We will see you next time on Simply Money.